I'm Matt Bouchard with REIT.com here in La Quinta, California for REITWise 2013, NAREIT's Law, Accounting, and Finance Conference. Joining me today is Sandy Presant, Chairman of the Global Real Estate Fund Practice Group with Greenberg Traurig. Sandy, thanks for joining us.
Nice to see you. My pleasure.
So first question, what are the chances that large portfolios of real estate that are now held privately will become part of the public markets, either through IPOs or even M&A?
All of them? Not a chance. Most of them? Probably. Okay. What we see with our clients are roll-ups are very important even when they're acquiring new things now. You can get a bigger bang for the buck when you take a whole portfolio public, merge it in through an UPREIT transaction, form your own private REIT and then become REIT bait for somebody, or ultimately be an acquirer and just assemble it. And the economies of scale are just so much when you have the big portfolios. It gets attention, it's exciting. It's good for everybody concerned. So I expect it's going to continue.
And we hear that the Treasury Department is considering proposing changes to bottom loss guarantees of partnerships. Can you explain a little bit about what the government's considering and how it could impact real estate partnerships?
What you're talking about on a bottom slice guarantee is guaranteeing the least risky portion of debt. So when people roll up and move property, to the extent they have negative capital accounts, in other words, they pulled out money through refinancing or they've taken losses or a combination of both, they have to, when they move that real estate, keep an equivalent amount of debt allocated to them. Well, when you move real estate into one of these big operations, you know, an UPREIT partnership, what have you, they pay that down and then they leave it on their line of credit. And you have to make sure that when the debt on your individual property is paid down, that you get replacement debt. So the way they do that is they have you actually guarantee debt, but nobody really wants to guarantee debt, okay, because they don't want the economic risk. So under a fiction that was created in the early 90s by the IRS, they let you say that it doesn't matter what part of a debt you sign on, the most risky part, the least risky part, in other words, $1 of loss, you bear that $1 of loss, or they have to lose $1,000 before you bear your $1 of loss, they count the same for keeping debt and keeping you from recognizing gain when you transfer it in. So and that's a long way of saying it's a good deal for the taxpayer to be able to sign on the bottom line when you have lots of assets in front of you and really don't have the financial risk. Well, the IRS is starting to close that down, or at least considering closing that down. And the problem is commerce in real estate is so important now, when you have the economy and the situation that it's in, that anything that the government can do to promote that commerce should be adopted, and anything they can do that could chill that commerce must be left alone. And they're not leaving it alone. And that's a real problem.
Sandy, thank you so much for joining us.
My pleasure.
For more on this and other REIT news and analysis, be sure to visit REIT.com.